And welcome back to the Lance Roper Show podcast, all here at realinvestmentadvice.com. We're on the line today with Kevin Smith from Crescat Capital. And of course, we're talking a little bit before the break about the Federal Reserve raising interest rates. And where you left off was saying that, well, if the Fed gets another whiff of a financial crisis, they'd be very quick to dropping interest rates again, instituting another QE program. One of the questions that I've always had is, the first time around, it was very effective because we were coming off a $500 billion balance sheet, not a $4 trillion balance sheet. There is a limited supply of bonds out there that the Fed can buy. And just how effective, potentially, given the potential drag of what will occur from such an inflated market that we have today, just how effective will QE and lowering interest rates actually be the next time?
Sure. I think that's a really good question. In the last financial crisis, when the Fed dropped interest rates and initiated QE, we actually had somewhat of a disinflationary response initially. And but what's happened over the past decade in the wake of all of that has just been a reinflation of asset bubbles. But now that we the next time that we go into a downturn and the Fed ramps up the money printing again, and central banks globally, the question is, will the world reflate asset bubbles, or will they start to fear something like inflation instead? And in the last crisis, we had more of a disinflationary fear, even though the Fed proved that it can prevent deflation. I think the most deflation we ever had in 2009 was like 1/4 of minus 1.4% CPI rate. I mean, that was the extent of deflation.
Right.
So this time around, it really comes down to how, are people going to lose a little bit more confidence in central banks to be able to control inflation? Are they going to go to reinflating financial asset bubbles, or are they going to start to hoard other assets like precious metals, or start to move towards more inflation hedge assets?
Mm-hmm.
And we didn't see that so much in the last crisis. It might work out a little bit differently this time. We've already seen money velocity start to break out a little bit, which is unusual. It's been declining for the last decade,
right.
But money velocity is on the rise again, and that's really a measure. In our view, that's a measure of people's confidence in inflation, confidence in central banks.
Mm-hmm. Well, again, it's been surprising that despite, and I agree with you on your point, which is that it's been very interesting to watch monetary velocity because it has been in a straight decline now for almost a decade. So during this entire ramp up of financial assets, strengthening, quote unquote, economic growth, everything that's been going on, the confidence within the economy really hasn't been there. And I think a lot of that really relates to the fact that a lot of this increase of the assets and the inflation of the asset bubble has really only existed for about 10% of the population. Most people have not really and most Americans have not actually benefited from the rise in asset prices. And so maybe now and as you saw, and as you mentioned, it has turned up lately, but that's turned up lately along with that we have seen some nominal wage growth kind of filter back into the system. Unfortunately, is it a little bit too late, is the question?
Sure, a little bit too late, perhaps. I mean, the rising wealth gap has been extraordinary in the last decade. It's only gotten worse. That's led to the rise in populism and nationalism, not just in the U.S. but globally. And I think that's really a consequence of financial asset bubbles being inflated and really only going to help the really top 1%. Where now we are getting you're seeing some wage inflation come into play, but there's just been too much share of, and this is what also goes into record corporate profit margins right now. Is just too much share of the corporate revenue pie going to the corporations and the equity holders, and not enough going to the workers at large.
Well, and so two things here I want to kind of get to, which is that as we look at Fed policy, and of course Jerome Powell, he's a little bit different animal than what we've seen previously. You know, Janet Yellen, Ben Bernanke, Alan Greenspan, their go-to thing was to lower interest rates, support the markets. If there was any type of volatility in the market whatsoever, somebody from the Fed was out talking up the markets. Hey, it's okay. Don't worry about it. We're here. We got your back. Jerome Powell's been very quiet on this front, and he's been very, very dogged about continuing to raise interest rates, continuing to say, hey, we're going to continue raising interest rates. And it's even gotten into the ire of the current president, who has made some comments about the Fed being, quote unquote, out of control. Is Jerome Powell, do you think, is he making the right decision? Is he moving too far, too fast? Or is he just doing what he can to be prepared for what he believes is a coming recession?
Sure. I think, business cycles are inevitable, and Jerome Powell is doing the right thing to try to get ahead of the curve globally on raising interest rates, and being able to then not only to help contain the bubbles that are out there currently from getting even bigger, but being able to have some dry powder, if you will, to reverse monetary policy when we do get into trouble. I think that the Fed has done a good job, but in that respect, by raising interest rates, by being the first central bank to lead the way. But the problem is that both the Fed and central banks globally have run too easy monetary policy for too long to think that they can smooth the business cycle, that they can prevent the business cycle from happening, and with the consequence only being that all of the manipulation has only created greater and greater asset bubbles each time around. We have, we're not going to escape. What is a recession? A recession starts with with a stock market downturn. A recession starts with financial asset bubbles bursting, and you don't even know you're in a recession until a couple of quarters later, when NIBOR declares it a recession. But it's like in China right now. China is almost certainly in a recession today already, given how much its markets are down and the capital flow situation going on there. So they're going to create a recession, the central banks, because the asset bubbles are going to burst first, and that's how the economic cycle works.
Well, let's take a quick break. We're going to come back, and we're going to wrap this up. Kevin, really appreciate your time today. We're going to wrap our conversation up. I want to drill this right back down to where you and I started, which is talking about the U.S. market, where we are, what you're seeing now. And of course, you've been right on the right side of the ticket this year with the pickup in volatility, the decline in stock market assets. But is this only the beginning is the question. And we'll come back, talk more with Kevin Smith of that right after the break. Kevin Smith, CEO of Crescat Capital. And you're listening to this interview at realinvestmentadvice.com. I'm your host, Lance Roberts, for the Lance Roberts Show podcast. We'll be right back.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.